Hello friends, we are going to discuss about the elements of working capital and importance of working capital management in this program. Working capital management is one of the key functions of financial management. Financial management is concerned with the efficient use of important economic resources, namely capital. The capital can be used to invest in two forms, that is fixed assets and the current assets. Fixed assets are a major portion of the capital funds used for investing in purchase of fixed assets for permanent or long-term purposes for the purpose of diversification, expansion of business, renovation or modernization of plant and machinery, and research and development. And current assets are the portion of funds needed for short-term purposes like investing into assets for current operations of business is called working capital. For example, one who is managing a trading business has to arrange funds regularly for purchase of finished stock and keeping it in storeroom, and also find suitable customer to go for sales. On the other hand, if it is a manufacturing firm, he has to arrange for funds continuously for buying raw materials, keeping it for some time in store, then taking it for the process of converting into finished goods and ultimately selling it to the consumers. The subject experts of this program are Dr. Naseeb Ahmed and Dr. Ashraf Ilyan. Dr. Naseeb Ahmed is Honorary Deputy Director, Center for Innovation and Entrepreneurship and Associate Professor, Department of Commerce and Business Studies, Jamia Millia Islamia, a central university in New Delhi. He is having an experience of about 17 years as a teacher and researcher in the area of entrepreneurship and finance. He has organized more than 50 entrepreneurship development programs, workshops, seminars, events in the area of innovation and entrepreneurship. Dr. Ashraf Ilyan is a Senior Assistant Professor in Department of Economics, Jamia Millia Islamia, having teaching experience of more than 15 years. He has published several books and research papers and have organized several national and international conferences, seminars, etc. And I am Shivangi Anand. So let us start with a question. Why should entrepreneur know about working capital management? In a business organization, we find that most of the time entrepreneurs are concerned with various issues related to working capital management. They are worried whether there is enough cash available to pay bills, enough inventory exists to make and sell products, any excess cash is invested in interest-bearing securities. Accounts receivable are at a level that maximizes earnings. Short-term liabilities such as salaries payable and trade credit are used efficiently and at the lowest cost possible. Now, let us understand what is working capital management. Working capital management involves the relationship between a firm's short-term assets and its short-term liabilities. The basic goal of working capital management is to ensure that a firm is able to continue its operations and that it has sufficient ability to satisfy both maturing short-term debt and upcoming operational expenses. The management of working capital involves managing inventories, accounts receivable, accounts payable, and cash. There is a trade-off between the risk of having too little working capital on hand and the reduced profitability that results from having excess working capital. We can understand working capital in two different but interlinked senses. In the first sense, working capital refers to gross working capital, and in second sense, it is understood in terms of net working capital. Gross working capital. It refers to the firm's investment in current assets. Current assets are the assets which can be converted into cash within an accounting year or within an operating cycle. You can include here cash, short-term securities, debtors, accounts receivable and book debts, bills receivable and stock. Net working capital. The net working capital refers to the difference between current assets and current liabilities. Current liabilities are those claims of outsider which are expected to mature or payment within an accounting year and include creditors, bills payable and the outstanding expenses. In other words, you can say that this is the excess of current assets over current liabilities. Now let us understand what current assets and current liabilities are. What are current assets? Assets which can normally be converted into cash within a year or within the operating cycle are grouped as current assets. In other words, current assets are resources that are in cash or will soon be converted into cash in the ordinary course of business. Current assets constitute the following. Inventories. Inventories represent raw materials and components, work in progress and finished goods. Trade debtors. Trade debtors comprise credit sales to customers. Prepaid expenses. These are those expenses which have been paid for goods and services whose benefits have yet to be received. Loan and advances. They represent loans and advances given by the firm to other firms for a short period of time. Investment. Investment held in the form of money market instruments like treasury bills, commercial bill and commercial paper and gilt-edged securities. Cash and bank balance. These assets represent cash in hand and at bank which are used for meeting operational requirements. One thing you can see here is that this current asset is purely liquid but non-productive. What are current liabilities? Liabilities which are due for payment in the short run are classified as current liabilities. In other words, these liabilities are due within the accounting period or the operating cycle of the business. Most of such liabilities are incurred in the acquisition of materials or services forming part of the current assets. Current liabilities are commitments which will soon require cash settlement in the ordinary course of business. Current liabilities comprise the following. Sundry creditors. These liabilities stem out of purchase of raw materials on credit terms, usually for a period of 1 to 2 months. Bank overdrafts. These include withdrawals in excess of credit balance standing in the firm's current accounts with banks. Short-term loans. Short-term borrowings by the firm from banks and others form part of current liabilities as short-term loans. Provisions. These include provisions for taxation, proposed dividends and contingencies. Advance received from customers. Interest, tax, dividend, salary and wages payable. Statutory liabilities like ESI, PPF, co-op dues, sales tax, excise duty, etc. Now, let us discuss type or kinds of working capital. There are two types of working capital. First, permanent working capital. This component represents the value of the current assets required on a continuing basis over the entire year and for several years. Permanent working capital is the minimum amount of current assets which is needed to conduct a business even during the dullest season of the year. Second, temporary working capital. Contrary to the above, you will find that temporary working capital represents a certain amount of fluctuations in the total current assets during a short period. These fluctuations are increased or decreased and are generally cyclical in nature. Additional current assets are required at different times during the operating year. Variable working capital is the amount of additional current assets that are required to meet the seasonal needs of a firm, so is also called as the seasonal working capital. Now, let us discuss about the various components of working capital management. Working capital management comprises of managing the three major components of working capital, that is, first, inventory management, second, receivables management, and third, cash management. Let us discuss these three components in detail. First, inventory management. Inventories are stock of the product a company is manufacturing for sale and components that make up the product. Various forms in which inventories exist in a manufacturing company are raw materials, work in process, and finished goods. Raw materials are those basic inputs that are converted into finished product through the manufacturing process. Thus, raw materials inventories are those units which have been purchased and stored for future production. Work in process inventories are semi-manufactured products. They represent products that need more work before they become finished products for sale. Finished goods inventories are those completely manufactured products which are ready for sale. Stocks of raw materials and work in process facilitate production, while stock of finished goods is required for smooth marketing operations. Thus, inventories serve as a link between the production and consumption of goods. Now, the question that arises is, why at all do we need to hold inventory? Do you have any idea? The question of managing inventories arises only when the company holds inventories. Maintaining inventories involves tying up of the company's funds and incurrence of storage and handling costs. If it is expensive to maintain inventories, have you ever wondered why companies hold inventories? There are three general motives for holding inventories. Transaction motive emphasizes the need to maintain inventories to facilitate smooth production and sales operations. For uninterrupted and proper running of any firm, it is necessary to have an appropriate level of inventory. Precautionary motive necessitates holding of inventories to guard against the risk of unpredictable changes in demand and supply forces and other factors. Speculative motive influences the decisions to increase or reduce inventory levels to take advantage of price fluctuations. Now, let us discuss the objectives of inventory management. No activity is undertaken without some aim or objective. Let's now come to the objectives of inventory management. In the context of inventory management, the firm is faced with the problem of meeting two conflicting needs: to maintain a large size of inventory for efficient and smooth production and sales operations, to maintain a minimum investment in inventories to maximize profitability because idle blocking of funds earn nothing. As we discussed earlier, both excessive and inadequate inventories are not desirable. These are two danger points within which the firm should operate. The objective of inventory management should be to determine and maintain optimum level of inventory investment. The optimum level of inventory will lie between the two danger points of excessive and inadequate inventories. Firms should always avoid a situation of overinvestment or underinvestment in inventories. The major dangers of overinvestment in inventories are: A. Unnecessary tie-up of the firm's funds and loss of profit. B. Excessive carrying costs. C. Risk of liquidity. On the other hand, the consequences of underinvestment in inventories are: A. Production holdups, and B. Failure to meet delivery commitments. Inadequate raw materials and work in process inventories will result in frequent production interruptions. As you can gather from our discussion, inventory management to be effective should ensure a continuous supply of raw materials to facilitate uninterrupted production, maintain sufficient stocks of raw materials in periods of short supply and anticipate price changes, maintain sufficient finished goods inventory for smooth sales operation and efficient customer service, minimize the carrying cost and time, and control investment in inventories and keep it at an optimum level. Now let us discuss about the second component of working capital, that is receivables management. One of the very important components of working capital is receivables. We know that business firms generally sell goods on credit to facilitate sale, especially from those customers who cannot borrow from other sources or find it very expensive or difficult to do so. For the existence of firm, it is essential to sell on credit. Finished goods sold on credit get converted into receivables, that is book debts, which when realized generate cash. Since receivables often account for a significant proportion of the total assets, management of receivables take up a lot of the finance manager's time. Can you all tell me why should a firm in the first instance sell goods on credit, or what is the purpose of receivables? The purpose of receivables can be understood if we can grasp the basic objective of receivables management. The objective of receivables management is to promote sales and profits until that point is reached where the returns that the company gets from funding of receivable is less than the cost that the company has to incur in order to fund these receivables. Hence, the purpose of receivables is less than the cost that the company has to incur in order to fund these receivables. Hence, the purpose of receivable is directly connected with the company's objectives of making credit sales, which are increasing total sales, as if a company sells goods on credit, it will be in a position to sell more goods than if it insists on immediate cash payment. Increasing profits as a result of increase in sales, not only in volume but also because companies charge a higher margin of profit on credit sales as compared to cash sales. In order to meet increasing competition, the company may have to grant better credit facilities than those offered by its competitors. Now let us discuss the third component of working capital management, that is cash management. Cash is the most liquid asset of all and is vital for existence of any business firm. Its efficient management is crucial to the solvency of the business because cash is the focal point of the funds flow in a business. It can be understood in two senses. One is actual cash held by firm and deposits withdrawable on demand, and in another sense it includes marketable securities which can be convertible into cash immediately. The goal of cash management is to reduce the amount of cash that is being used within the firm so as to increase profitability, but without reducing business activities or exposing the firm to undue risk in its financial obligations. Cash flows in connection with credit serve to introduce the concept of float, which is the time lag or delay between the moment of disbursement of funds on the part of the customer and the moment of receipt of funds on the part of the seller. That is, mail time, processing time and clearing time with the banking system. What factors must be considered when deciding on the appropriate amount of cash to hold? Cash in checking accounts must be held so that bills are paid on time, that is transactions balance, for emergencies such as strikes, weather disruptions, etc., that is precautionary balance, bank requirements for loans or other services provided such as compensating balance, and for taking advantages of bargains, that is speculative balance. There are four motives for holding cash. First, the transaction motive. Firms are in existence to create products or provide services. The providing of services and creating of products result in the need for cash inflows and outflows. Firms hold cash in order to satisfy the cash inflow and cash outflow needs that they have. Second, the precautionary motive. Holding cash as a precaution serves as an emergency fund for a firm. If expected cash inflows are not received as expected, cash held on a precautionary basis could be used to satisfy short-term obligations that the cash inflow may have been benchmarked for. Third, compensating motive. Banks provide a variety of services to business firms such as clearance of check, supply of credit, etc., for which a minimum balance is required to be kept with the bank. This balance is to compensate banks for services rendered. Fourth, the speculative motive. Economist Keynes described this reason for holding cash as creating the ability for a firm to take advantage of special opportunities that, if acted upon quickly, will favor the firm. An example of this would be purchasing extra inventory at a discount that is greater than the carrying cost of holding the inventory. Cash management is concerned with the managing first, cash flows into and out of the firm. Second, cash flows within the firm. Third, cash balances held by the firm at a point of time by financing deficit or investing surplus cash. Importance of working capital management. At times, business needs to estimate the requirement of working capital in advance for proper control and management. The factors discussed above influence the quantum of working capital in the business. The assessment of working capital requirement is made keeping these factors in view. Each constituent of working capital retains its form for a certain period, and that holding period is determined by the factors discussed. So, for correct assessment of the working capital requirement, the duration at various stages of the working capital cycle is estimated. Thereafter, proper value is assigned to the respective current assets depending on its level of completion. The basis for assigning value to each component is given here. Component of working capital, the basis of valuation. Each constituent of the working capital is valued on the basis of valuation enumerated for the holding period estimated. The total of all such valuation becomes the total estimated working capital requirement. The assessment of the working capital should be accurate even in the case of small and micro enterprises where business operation is not very large. We know that working capital has a very close relationship with day-to-day operations of a business. Negligence in proper assessment of the working capital, therefore, can affect the day-to-day operations severely. It may lead to cash crisis and ultimately to liquidation. An inaccurate assessment of the working capital may cause either underassessment or overassessment of the working capital, and both of them are dangerous. Consequences of underassessment of working capital. Growth may be stunted. It may become difficult for the enterprise to undertake profitable projects due to non-availability of working capital. Implementation of operating plans may become difficult, and consequently the profit goals may not be achieved. Cash crisis may emerge due to paucity of working funds. Optimum capacity utilization of fixed assets may not be achieved due to non-availability of the working capital. The business may fail to honor its commitment in time, thereby adversely affecting its credibility. This situation may lead to business closure. The business may be compelled to buy raw materials on credit and sell finished goods on cash. In the process, it may end up with increasing cost of purchases and reducing selling prices by offering discounts. Both these situations would affect profitability adversely. Non-availability of stocks due to non-availability of funds may result in production stoppage. While underassessment of working capital has disastrous implications on business, overassessment of working capital also has its own dangers. Consequences of overassessment of working capital. Excess of working capital may result in unnecessary accumulation of inventories. It may lead to offer too liberal credit terms to buyers and very poor recovery system and cash management. It may make management complacent, leading to its inefficiency. Overinvestment in working capital makes capital less productive and may reduce return on investment. Working capital is very essential for success of a business and therefore needs efficient management and control. Each of the components of the working capital needs proper management to optimize profit. Now let us see the factors that affect working capital requirements in a business firm. There are no uniform rules or formulae to determine the working capital requirements in a firm. A firm should not plan its working capital neither too much nor too low. If it is too high, it will affect profits. On the other hand, if it is too low, it will have liquidity problems. The total working capital requirements is determined by a wide variety of factors. They also vary from time to time. Among the various factors, the following are necessary. First, nature of business. The working capital requirements of an organization are basically influenced by the nature of its business. The trading and financial institutions require more working capital rather than fixed assets because these firms usually keep more varieties of stock to satisfy the varied demands of their customers. The public utility service organizations require more fixed assets rather than working capital because they have cash sales only and they supply only services and not products. Thus, the amounts tied up with stock and debtors are almost nil. Generally, manufacturing business needs more fixed assets rather than working capital. Further, the working capital requirements also depend on the seasonal products. Second, size of the business. Another important factor is the size of the business. Size of the business means scale of operation. If the operation is on a large scale, it will need more working capital than a firm that has a small scale operation, which is manufacturing. Third, credit terms. The level of working capital is also determined by credit terms, which is granted to customers as well as available from its creditors. More credit period allowed to debtors will result in high book debts, which leads to high working capital and more bad debts. On the other hand, liberal credit terms available from creditors will lead to less working capital. Fourth, operating or manufacturing cycle. The length of manufacturing cycle influences the quantum of working capital needed. Manufacturing process always involves a time lag between the time when raw materials are fed into the production line and finished goods are finally turned out by it. The length of the period of manufacture in turn depends on the nature of product as well as production technology used by a concern. Shorter the manufacturing cycle, lesser the working capital required. The time period of operating cycle can be calculated with the following equation, wherein O is equal to R plus W plus F plus D minus C, where O is equal to duration of operating cycle, R is equal to raw material average storage period, W is equal to average period of work in progress, F is the finished goods average storage period, D is the debtors collection period, C is the creditors payment period. Fifth, speed of turnover. If the inventory turnover is high, the working capital requirements will be low. With the better inventory control, a firm is able to reduce its working capital requirements. When a firm has to carry on a large slow-moving stock, it needs a larger working capital as against another whose turnover is rapid. A firm should determine the minimum level of stock which it will have to maintain throughout the period of its operation. Sixth, seasonality of operation. Firms which have marked seasonality in their operations usually have highly fluctuating working requirements. Let us take an example to illustrate this point. Consider a firm manufacturing air conditioner, that is the AC. The sale of AC reaches a peak during the summer months and drops sharply during the winter period. The working capital need of such a firm is likely to increase considerably in summer months and decrease significantly during winter season. Seventh, business cycle. Cyclical changes in the economy also influence quantum of working capital. In a period of boom, that is when the business is prosperous, there is a need of larger amount of working capital due to increases in sales, rise in price, etc. and vice versa during period of depression. Eighth, dividend policy. It has a dominant influence on the working capital position of a firm. If the firm is following a conservative dividend policy, the need for working capital can be met with retained earnings. Ninth, production policy. The requirements of working capital are also determined by production policy. When the demand for the product is seasonal, inventory must be accumulated during the off-season period, and this leads to more cost and risks. These firms which manufacture a variety of goods will have advantages of keeping low working capital by adjusting the production according to the season. 10th, growth and expansion. As the company grows and expands logically, it requires a larger amount of working capital. Other things remaining same, growing industries need more working capital than those that are static. This is the end of today's session. I hope you liked this session. Have a nice day and thank you.